Hello and welcome back to the ROI channel, the channel that is obsessed with all things to do with the art and science of return on investment. Today we're going into another medium depth analysis of a position that we hold in the Crassus Fund, our portfolio on eToro. If you haven't already liked and subscribed to the channel, please do so. We'd greatly appreciate that. If you want to see more of these analyses, that will help the channel continue to grow, and we can put more and more time and effort into going over different opportunities out there in the public capital markets. Now, today we're heading into an area of the world that's a little bit controversial, being Russia. However, I am bullish on Russia's future for many, many different reasons, not the least of which is they appear to have the only central banker that is thinking about preserving the currency. Probably tells us a little bit about the state of the world at the moment when the Russians are teaching us about the integrity of currency. They have bought a lot of gold, the Russians, meaning that they have almost about 20% of their GDP in reserve weights of gold. So very, very interesting moving into the future. Russia is very rich in natural resources, as everybody knows. And probably the pick of the bunch when it comes to their natural resources is their gas pipelines. Okay, so Russia supplies the world in a lot of ways, but particularly Europe through their pipelines. And the biggest gas company in the world, I believe, certainly the biggest Russian, is the powerhouse Gazprom. Okay, so it's partially owned by the state. Okay, so the Russian government owns a huge stake of Gazprom. And given where the world is heading in terms of clean energy sources, the amount of energy used via natural gas will continue to increase over time as we move towards this idea of electrification and low greenhouse emissions. So it'll be very interesting to see where we end up. And today we're going to talk about Gazprom. So without further ado, let's get into it. Quick recap of our investment formula. When we're looking at investments in general, we want to have low debt, a strong balance sheet, margin of safety, and we want to have sales growth, strong margins, free cash flow growth, and share buybacks over time. So we're going to see how Gazprom stacks up to that. Some quick facts about the company itself. We have here, I've converted it all into US dollars. So obviously the company trades with the rubles. They've got many different listings out there. We use OGZD in the fund, which will be listed on the London Stock Exchange. Full disclosure, about a year or so ago, I bought into Gazprom, my personal portfolio, and I have some different listings there. The revenues in US dollars, you can see there. Over the long term, I've gone back over a decade to get a smoothened average of the compounded annual growth rate. So think about the cyclical commodity producers. Their revenues are heavily tied to the underlying commodity which they sell. So you're going to have this cyclicality of gas prices go up, they go down, they go up, they go down. And over time, you need to get an understanding as to what that can be over probably at least a decade to 12 years so that you get a good idea of what you can buy the company for and basically insinuate a certain return based on those numbers. If you just look at a given year on year, well, it might be a good year, might be a bad year, and that will obviously overstate or understate the projected return. EBITDA here, so they're slightly sneaking up in their margins over time. Their net debt to EBITDA 2.11. Their total debt to EBITDA is about 3, and that's the max which we would allow. And if you look at most commercial credit analysts, they will allow a maximum of 3 times the EBITDA as a lender. So if you come to me and you say, I want to borrow X amount, you want to borrow 400 grand, for example, and your annual earnings before interest, tax, depreciation, and amortization happen to be 100 grand, I would say, no, you've got to, I can give you a maximum of 300 grand as a loan. Same concept applies when we're looking at publicly traded investments. There are the shares on issue. What happens with producers generally is through the lean years, they try and issue shares or issue bonds, issue notes to be able to fund themselves through the lean times, because it's feast or famine. And as you can see here, they have issued more than they've repurchased, but the dilution risk I consider to be fairly low, as it's been less than 1%. Return on capital, 4%. It's been pretty standard for a big, basically state-owned commodity producer. There's the market cap in US dollars, and the current share price for the London Stock Exchange listing, $7.65. Okay. Going through the annual report, as I switch my face over there, here are what I believe the most pertinent parts of the report. The capacity of production of this company is enormous. Okay, so 453 billion cubic meters of gas is what they can produce, and they're going to increase that by 20%. It's estimated in 10 years. So already they're the biggest gas producer in the world. They're going to be an absolute behemoth, which, leaving daylight between them and the next competitor over the next few years. When it comes to a play like this, it's about the dividends as much as anything else. So when you look at the yield that this thing is giving you, it's a cash cow. Okay, there's a lot of uncertainty in the future. There's some political uncertainty, there's commodity risk, and so on and so forth. So we are wanting to be compensated by the fact that they are actually going to take their free cash flows, generate a heap of it, and pay out a lot of that directly to us as dividends. So we're getting paid to wait, and that will be a rather large compensation for the risk that we perceive that we're taking investing in the company for a longer term. A 50% payout ratio. So of the earnings that they produce, 50% of that is going to go straight out the door to us as the shareholders in the way of dividends. So we're looking at about 20 bill US this year. So you're looking at $10 billion in dividends alone. If we go back to the market cap, okay, 91.3 bill, and we're expecting to get 10 billion in dividends. I mean, that's more than a 10% yield, okay, which is fantastic. And margins continue to grow. They're expecting to add another $4 billion per annum in EBITDA over the next decade, which again will grow that free cash flow, and more of that will be paid out to, or half of that will be paid out to us as dividends. Quick screenshot here of natural gas and what it's done. It's been on an absolute mission over the last year. So we had demand concerns during COVID, so for some reason it sold off. I guess business is not open as much in Europe, so you're going to be using less gas there, but a lot of domestic houses use gas for heating and cooking, etc., hot water systems and so forth. So it was definitely oversold. I made a lot of money this year buying futures contracts and derivatives on the actual gas price itself. And so now what I've done is I've sold. I've got a sort of 200 and 300% return on those. I'm selling them and rolling that capital into a high yield, high upside potential opportunity for companies like Gazprom. There's some others that aren't traded on eToro, so they're not in the fund, but some Canadian mid caps in the oil and gas sector look very, very cheap. So I've been scooping them up with the profits made off the futures in oil and gas. Continuing, I think that $5 over the next year, it sounds crazy, but it's probably not unreasonable in terms of where gas prices are going to go. We've had a lot of supply disruption, which is the general thesis for the commodities super cycle, which a lot of people are predicting. And once the tap is turned on, so to speak, when it comes to gas, I think that we're really going to start to ramp up the economy with this reflation idea. And so commodity prices in general will rise, and I think natural gas will continue to be a beneficiary of that. Short-term projections, we're looking a year out. This is what the company is expecting. This is what analysts are projecting. We've got a free cash flow projection, and we've got our dividends. So for Gazprom, it's all about the dividends. That's how we're looking to value it. If you look at the free cash flow and we look at the multiple, look how tiny that multiple is. And that's historically relevant for this particular company. It goes with the geographical location of the company and the perceived political risk. But if you look at the US and the Keystone Pipeline being shut down, I mean, I think that people are overstating political risk in Russia. This is, again, partially owned by the state. So the Russians are not silly. They're not looking to shoot themselves in the foot. and you're paying 2.6 times the free cash flow of that company. And that company happens to be the biggest producer of a commodity, which I'm heavily, heavily bullish. So I think that that's just way too cheap. If we were to get, we could easily get a doubling of that multiple, and then you'd have a doubling of the share price. The dividends alone. So if we strip all that away and we say, okay, people are still going to be afraid of Russia and they're not going to pay those multiples, what are we getting in cold hard cash at the end of the day via dividends? So we're getting a yield of about 11 or 12% at the moment. For Russian companies, that should be around about 7%. That's what the median would be for those producers in that part of the world. So we're undervalued with one of the better producers, in my opinion. So if we were to just simply mean revert or median revert in terms of the yield on the dividend, that would be the price up to around $12.57 in the next year, which is a 64% upside. So what would happen if we took the expected free cash flows and dividends and we ran it over 10 years through our IRR projections? This is what we would look like. So we're entering in at 7.65, and these are the stream of cash flows we're expected to receive, and an exit multiple, which again, we're being very conservative. This could be a lot higher than that if the market starts to re-rate what they're willing to pay for Russian commodity producers. This is the cost of capital for the company, and that's interesting. So most of that is denominated in US dollars and euros. Given the fact that Russia's been quite smart in acquiring gold, I think that it's not outside the realm of possibility that the ruble will strengthen, and so maybe that the real rate of that finance will drop. But then will that impact their ability to export gas prices because their local currency is increased? Remains to be seen. So we've just kept a finance rate at the cost of capital the way it is. And again, the reinvestment rate, what if we took the dividends and we reinvested it at the same rate as the cost of capital? What would that give us as an annualized IRR? We're looking at over 70%. So that should, in most conceivable scenarios, easily beat the broader market. So it's worth taking some of that idiosyncratic risk and investing in the individual company, because we're going to be well compensated for that. Dividends alone, let's have a look. So if this is what the dividend is expected to be, and this is what we expect as a growth rate of that dividend, and this is our target return, could we make our 20% IRR that we require as investors through the dividends of this company alone? And if we're getting that paid out to us, whatever happens to the share price at the end of, say, 10 years, we don't really mind because we've been paid back in spades. Okay, so it's not often that you can get an opportunity like this, but when one comes up, it's well worth looking at. So what would be the price at which we'd have to buy the shares or below? We're looking at around that 766. Okay, so we're right on that now. And what this means here, this particular graphic, is using the dividends and having them grow at a rate of growth over perpetuity. Okay, so this is the nominal amount of dividends in the darker green that we're estimating, but we've got to discount that back to today's money using our discount rate. We're using a heavy discount rate of 20% because that's our required return. And so what you need to get your head around is that, yes, exponentially those dividends will increase nominally, but don't forget we're discounting them at an exponential rate also. Okay, so the net value of those future cash flows, in this case only the dividend cash flows, we're discounting that back today and say, okay, what is the net present value of those? And we're looking around about the current share price. So the current share price is about $7.65. As I mentioned, we can buy it at that and expect to receive our return. So worth considering. And the question is, do I think that that's going to compensate the risk for me as the investor and the fund manager? And the verdict is yes. So I have bought Gazprom. It's a bit less than 4% assets under management. It makes up part of our energy play alongside Southwestern Energy and ExxonMobil, which we will talk about at a later date. It's got a low enough debt. It's not low debt compared to some of the other companies we've looked at, but it's well within our net debt to EBITDA margin of less than 3. It's got margins of safety, being that we're not expecting the multiples to rise. We're getting those dividends, and and we're getting our required return come what may. So if we get a multiple expansion, which the company, in my opinion, probably deserves, then that's just going to increase our returns on the upside. Sales growth, capacity upgrade, strong margins, strong enough. I mean, they're growing their margins, growing their EBITDA more than their top line revenue. So the margins are increasing. Free cash flow growth. It's not going to buy back shares. Okay, so that's technically a cross. But what we're getting instead of share buybacks is the company's just giving out those cash flows to us via dividend, which is just as good. You just got to take your tax consideration into account. 3.6% assets under management. I think that we can really grow to like the company over the next few years. If you haven't checked out the socials already, follow me on Twitter. It's the ROI channel where I put out some of my thoughts. Instagram also. And if you're considering investing on eToro, perhaps you want to look at the portfolio and potentially put some funds towards that if you want to copy it. Very easy. You download the app on your phone and you decide how much you would like to invest. And if you want to put forth money to copy the portfolio, I believe the minimum is $200. However, if you decide that that's something for you, you probably want to look towards the $500 mark now, because that will properly sync with all the portfolio positions, because I've added more. Okay. As always, I'd appreciate it if you like and subscribe to the channel. Leave any comments if there's any particular analyses you'd like me to do. As always, use your best judgment. Okay. It's a disclaimer. I'm not a financial advisor, so make sure you take that into account when doing any type of investment. You should do your own due diligence. That's only common sense. Don't be lazy. It is a bit of work, as you can see. There's a fair bit to think about, but that's where the outsized returns are. Thank you very much for watching. I'm going to leave it there, and I look forward to seeing you in the next video.